Hi, my name is Scott Brady. I'm the owner of Progressive Property Management. And you found this site probably from some marketing pieces we sent to you, and you're interested about the trends that are occurring to your investment property. And there are definitely trends going on right now. And so I call this website and this slideshow the Coming California Renter State. And specifically, renter state means there are more renters than owners. And what happens is, of course, the laws are impacted because your elected officials, both on a state level, local level, they want to stay elected. And to do so, they start pandering to the majority. And when the majority of voters are tenants, those are the kind of laws you see coming through. So that affects your investment property. I want to talk about for the next half hour or so about those trends, what you can do, and a little bit about our company. So the renter state, as I just kind of defined for you, I consider a renter state when you have more tenants than owners. And there's only two states in that predicament right now. That's California and New York. And in California, it's really escalated quickly just the last few years. And we'll talk about why that's happened. So that tipping point isn't when it's 50-50. It's more like when it's 60% of the households are tenants and 40% are owner occupied, because a lot of tenants don't vote. And so it's not just 50-50, but once the 60% of the households are tenant or rent, basically rented, then you start seeing the local laws changing. And certainly on a statewide level, we've seen that change as well. And we'll, of course, go over that. Once again, the elected officials, they're here to stay in office. And what do tenants want? It's always the same playbook every time. They want rent control. They want just cause eviction, meaning that they cannot be removed from a property if they're behaving and paying as agreed. And you're seeing banks and Wall Street betting on this. Gavin Newsom has said that he wants a minimum of 300,000 units to be built each year in the state of California. He doesn't care about owner-occupied or rental. He just wants more units. And right now, 80% of the properties being built in the state of California are rentals. And you've seen them. If you drive by anywhere in Southern California, you'll see a huge apartment complex, 200-300 units with a wrapped around a parking garage, so the garage is next to it. And Wall Street's putting a lot of money into that right now. As I tape this, is late April. We are currently in the midst of the global pandemic for the coronavirus. And already they've passed a lot of, they claim, temporary laws to help tenants. But you and I both know temporary laws become permanent because tenants like those laws. Just like we raise taxes and we say, well, it's just temporary for a few years to get us through this tough time, and they become permanent. Same thing with some of these laws. You know, bottom line, I think this is what's important here, is that when it becomes more appealing to rent than it is to own, people are going to rent. Even though we had a recession, of course, in '08, but we've had just unmitigated increase in rent and property values particularly the last 10 years. And home prices are just too high. And what you see, particularly along the coastal areas, is that nobody wants to build new housing. And that forces the prices of housing even higher. There's really a lot of less long-term job security. We're seeing that right now in this current pandemic. We went from 3% unemployment to now we look like 20% unemployment. And as our economy is much more about consumerism, it's much more easy to let go of those type of employees. They're not high-skilled people. It's the guy that brings you food, or it's the person that provides a service that can be provided by somebody else. We're not going to talk a whole lot today about technology acceleration. That's the next tsunami. Driverless cars, driverless trucks, artificial intelligence. But it's definitely creating a lot less job security in the marketplace. Proposition 13 is under siege. Property taxes are increasing, and there's a measure coming up in November and made the ballot for split roll. And that would say, well, gee, we're not going to change how we look at taxes for residential property, including apartments, but we will look at commercial industrial property, and they'll be taxed at current market value. And that'd create $10-12 billion additional revenue. I don't know if we'll go through now because of this, but they'll try again. There's really no social cost to be a tenant now. I'm a pretty old guy. When I got out of college, one of the first questions somebody asked you is, do you own? You'd say, well, it was kind of a race to own something. It was sort of an important part of our fabric. It's not that important anymore. There's no cost, if you will, social cost not to be an owner. And here's what I would say. If you can live in a property and they can't raise the rents and they can't remove you and you don't have to fix anything, why buy? I mean, because when you own, there's a cost involved. There's maintenance costs and there's taxes, and taxes go up and all that stuff. So that's where we're kind of going, and that's the scary thing about this renter state. So what is that tipping point? We talked about the 60. Let's look at some stats. So this is currently in California, some of the cities, and you can see any city where it's at 60% has rent control, or certainly considering it. And now it's even getting closer to 50%. It's interesting that you don't need the 60% threshold anymore. Even if you get close to 50%, you start hearing talk about rent control, rent cap. Because they just passed a statewide rent control, I think that's mitigating a little of this. But we'll talk about that. Doesn't cover all properties, and that will be the next push. Right now, our statewide rent control, and by the way, the rent cap is really high. You can increase rents 5% over CPI, or a consumer price index. That runs about 8% a year. So I think you're going to see some changes locally and tightening that up and including more properties. What is interesting, how everybody supports rent control. It's just not tenants. Of course, you expect a renter, 65% of renters will want rent control. But when even even homeowners and the majority of homeowners support it, 55%, statewide 60%. That's why you're seeing all these laws, that there's less pushback from people on property. And homeowners, I think the attitude is, well, I don't rent. I feel bad for them. They should get rent control. But if they turn the property into a rental, they're going to be in the same situation with all these different laws. So where did all the homeowners go? Because for many, many years, by far the vast majority of households were owner occupied. Well, you can see typically in the past, and this is going back to 80, as interest rates went up, home ownership went down. 80s, you can see when rates skyrocketed, home ownership plummeted down to 53%. And then as rates got incredibly low in the early 2000s, home ownership rates went way up. A part of that wasn't just interest rates. It was, if you don't remember, if you forget, it was you didn't have to stated income, no money down. Loan was out there. So of course that skyrocketed up to 60%. But even though interest rates have come down, and as I speak, rates are now almost like 3.5%, the homeownership rate is still declining. There's just less appeal to own real estate. We talked about the construction trends, the starts. We're starting to come up a little bit. We plummeted after the Great Recession, and we just haven't made up for all that lack of housing we have not been building. Once again, Newsom wants to build, a couple 100,000 units a year. His goal is 300,000, and we've been running about 90,000 total. But more and more, that's multi-unit, not single-family homes. And just culturally, just if you look at the different groups out there, the only group still buying at the same rate they have the last 20, 25 years are older people. It's people 65 and over. They understand about the benefit of home ownership and having a fixed mortgage. But if you look at the younger people, all down. So from 2000 and effectively 2004 all the way till today, we can go out to 2020. That graph keeps on going down. The younger people embrace renting. And we talked about the states. Bottom states are, of course, California, New York, Hawaii, Nevada. And so interestingly, the state with the highest rates of owner-occupied households is West Virginia. And you're like, why West Virginia? Well, when it's cheaper to buy than it is to rent. So in West Virginia, where the average home price is $175,000, and if you put 3% down with $5,000, you're an owner, and you get to write off the interest, and you get to write off the property taxes. It's actually cheaper to buy a property in West Virginia with 3.5% down than it is to rent. That's not true in California. Our average home price, for example, Orange County is running close to $800,000. You put 3% down, it's not cheaper than renting. You can rent that house for $3,000. So that's why we don't see, unless home prices just plummeted in California, not by 10% or 20%, by 30 or 40%. That's going to hold true. It's just cheaper currently in California to rent than it is to buy. I deal with elected officials all the time. I was one at one time. And you meet a lot of politicians who love the power, love being a politician, want to stay a politician. And when they're elected, their voters clamor for something, they capitulate. So this is kind of easy to the hard. Annual inspections gets adopted by many cities. What's the harm? We just want to take a look at the inside, make sure it's in good condition. We don't want you to look at a criminal history. There's no retaliation. So if a tenant calls a housing authority, you can't give them a notice to vacate. A lot of them implement housing authorities that then make sure that look at their housing stock, implement Section 8, do the inspections. You're seeing jury trials across the state where they want to do a jury trial rather than just in front of a small claims, they can get that. And then you move up. The next big thing is just cause eviction. So somebody wants to know that if they're renting a property, as long as they abide by the terms of the contract, pay as agreed, that you cannot remove them. That's just cause eviction. The only way to evict somebody is with just cause. They don't pay, they commit a crime, or they don't abide by the terms of the contract. And of course, the holy grail for everybody is rent control. They got their wish with the statewide measure that we're going to talk about, but wasn't everything they wanted. 8% annual increases isn't low enough. There are certain cities like Berkeley, which have, of course, more strict rent control, where you can only increase the rent 1% of a CPI. So I would argue the holy grail for tenants is CPI, just consumer price index. That'd be their dream. We'll see if they get it. Here's our guy, doing well during this pandemic. I think people believe that he's had the right balance, but he's arguably the most liberal governor ever elected. You can see his history on issues. He supported rent control. He pushed that bill through, and I don't think he's going to stop there. He'd said before he got elected, right when he got elected, that at his State of the State, that you give me a rent control measure and I'll pass it. And he did. He was a man of his word. So he's got a lot of weight right now in the state, and particularly with the legislature, because they know he's not going away. His approval ratings are high. So whatever he wants, he gets. So let's talk about the Tenant Protection Act of 2019. This was big. This was passed in October, and it's the first statewide rent control. That's huge. It's the first statewide rent control, but it doesn't cover all properties. So it carved out a number of properties, which you may see change. So what it specifically says, it says you can only, for multi-unit buildings, so 2 units or more, unless it's owned by a real estate investment trust, which doesn't apply to you guys, you can only increase the rent annually 5% over the consumer price index. So if the consumer price index is 3%, you can increase it 8% over the course of a 12-month period, either one time 8% or 4 and 4. And it can only increase it 2 times in any given year. What's included are multi-unit buildings, any properties owned by REITs, which are real estate investment trusts, and the properties have to be 15 years and older. So if it's a brand new 200-unit building, would be excluded until it becomes 15 years old. What's critical, what's excluded, are single-family homes and townhomes, and even a duplex if you live in one of the 2 units. So that's a large number of properties that were excluded. If you are included, it did include just cause eviction. So we have a few properties where we have, let's call it a 10-unit building, and we have a tenant that's way below market on rent. We inherit it from an owner. There's nothing we can do. We can't get rid of that tenant. It's only way we can do it is if we, and we'll go the exceptions in the next slide, but only way we can, if we say we're going to take over that unit and make substantive changes to it, improvements, at least 30 days, takes permits, something that's going to be at least $5,000, $10,000, $20,000, then we can pay that tenant. And how we can either pay them 1 month's rent, or they don't have to pay their last month's rent and they move on, which is far less abrasive than it is, like, for example, in LA rent control, where you can pay somebody up to $20,000. So that's the cost to get rid of a tenant if you want to take back the property. So when is it just cause relocation? So that's a relocation expense you're paying. So if you want to renovate the property, or let's say you want to reoccupy the property, which is kind of difficult if it's a 5-unit building, but let's say you can legitimately show you're going to reoccupy the property, then you would pay them 1 month's rent or let them not pay the last month's rent. And that's the cost to get your property back. Just cause, if you don't know, basically if they don't pay as agreed, you give them a 3-day notice to quit and you're gonna be able to evict them. So non-payment for us is typically the reason we're gonna evict a tenant. The other one is to cure the contract. That's if they say they have no pets and they have 4 pets. They say they have no roommates and they've got 3 roommates. Very hard to take that to court, because by the time you get to court, they've already cured it. So obviously non-payment's an easier way to get rid of a tenant. So actions you have to take as an owner. One, you have to give them it's called a rent cap just cause disclosure. And basically you're telling a tenant either your property is included in this new law or it's excluded from this law. So if you have a single family home, you're obviously excluded, but you have to tell the tenant that, because maybe they don't know you're not a real estate investment trust, which of course you're not. You still have to let them know. And then come July, it's going to be in all new leases. So right now you have to give them a disclosure, and there are forms we can provide to you. You can find online, but in July will be actually be in the lease itself. So you're disclosing to them if they benefit from the law, and then it gives out the details of the law. Okay, so disclose. The other law that passed that a lot of you are not aware of, that's important to know, and we called it the mandatory Section 8 law. So basically, they included Section 8 income as part of the fair housing. So you can't discriminate against somebody based on their source of income. You can say, why would I discriminate? Let's say that your tenant is a stripper. So there are a lot of ladies out there. You can't discriminate. You can't say, I don't like your source of income. Well, Section 8 is no different now. So if somebody says they're on Section 8, you can't say, we don't accept Section 8. You can't say that. That's how you're violating fair housing law. So you can say, we'll consider it, but you have to meet the standards for all our other tenants, which could be credit scores, of course. It could be the amount of the security deposit. So you just can't say no. Also, typically Section 8, depending on where your property is located, the rent they're willing to pay, so Section 8 is a federal program, and they say, hey, tenant, you don't qualify based on your income for the normal rent. So let's say market rent in their opinion is $1,500, and they only make $1,500 a month total income. Then the government says, tell you what, you put in $500, we'll put up $1,000. So go find a rental property for $1,500 and you're good to go. Well, a lot of our properties just are at $1,500. So let's say your market rent, you're asking $1,700. You do not have to take these $1,500 a month. You can say, nope, ours is $1,700. Real important. If the tenant says, tell you what, I'll pay you the $1,500 with Section 8, and I'll give you $200, every month, in cash. Is that okay? The answer is no. That's violation of a federal law. You do not want to do that, because they told the government they only can afford this much, and they're telling you can afford more. So just the key thing is, don't say, no, we don't accept Section 8. We'll always consider all applicants, because the first time fine for a violation of fair housing is $21,039. So it's a big fine. You don't want to have to pay that. Okay, so be aware. And if you like Section 8, great. You don't care whatsoever. But if you're not a fan of Section 8, you need to be aware of what the laws are. So we're going through the coronavirus. We just had a bunch of emergency measures, and they claim these are temporary. We'll see. I'll update this video once we find out. But right now, we can't evict anybody until May 31st. We cannot file unlawful detainers. Foreclosures have been put off. Probably the biggest one is the courts have decided they're not going to hear any eviction cases until 90 days once the moratorium's lifted. Well, that's June 1st. That would be June, July, and August. So the first evictions they'll even hear is in September. They just think there's more pressing matters from the court than evictions. So that's already going to affect us by then. And that's when the line starts. Once again, we don't have all the numbers. They're coming in. But let's say 10% of tenants decide not to pay as agreed. And they're either doing partial payments or no payments. There are about 1 million rentals in the Southern California market, LA, Orange County, Riverside. That'd be 100,000 for potential evictions. Typically, the courts evict 2,000 to 3,000 people a month. It could take months to get through the backlog. So even though they can start hearing evictions in September, it may take 3 or 4 or 5 months after that to actually evict somebody. So what can you do? So you cannot post a 3-day notice to pay or quit. Okay, that's actually harassment, because you can't force them to pay in 3 days. But you can post a 3-day notice to pay. You can say, hey, I think it's a good idea if you pay. Hey, I want you to pay in 10 days, work something out. You can do inspections, of course. You still have the same right, 24-hour right of entry. And of course, you've got to maintain the property. Even if the tenant's not paying and they say they have a water leak, you've got to fix a water leak. You can't say, hey, you pay rent, I'll fix the leak. It doesn't work that way. The courts at this point don't know if the tenant's entitled not to pay. So they assume until you get to court and they decide who's right or wrong, you've got to maintain the property as if they were paying. So there was a couple of proposals on the ballot. This is now up in the air because everything going on with coronavirus, if they qualify, because they're going to change it. But I think it's important to know this is on the horizon. If it's not this election, the next election. So the big one is vacancy decontrol. If you're not familiar with that, what they want to do now is say, okay, so a tenant leaves for whatever reason, on their own volition, or you evict them. rather than you being able to take your rent to market. So a tenant's in there for $1,500, you evict them, but the market rent is say 2,000. Right now you could take it to 2,000. They're saying, no, 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 no. You remove a tenant and you fix it up for 30 days. Now you can only increase it 15% over a 3-year period. Wow. So that stops people from doing these, remove the tenant, fix it up, and put the property at a much higher rent. So that was on the ballot. We'll see if it stays on the ballot. The other thing it excluded was it included in rent control and vacancy decontrol if you own 2 or more properties. Not a duplex. If you own 2 single-family homes, you're thrown in. So that's a game changer. Now, it doesn't get us down to 1 single-family home. You'd still be excluded, but if you own 2 or 3 properties, now you get lumped in with everybody else. The other thing that's been going around other states, and I think it's something that could be coming here, is it's called first in line. So you get 2 applicants. You get an applicant to come in. Your standards are that you'll look at anybody with a credit score of 650 or above. But so they have 650 credit scores. They barely make enough income to qualify, and they've got two comfort animals. But then 4 days later, you get a husband and wife, 800 credit scores. They make 4 times the monthly rent, perfect credit. First in line says you'd have to take the first applicant. You can't, because they think that's not what you're doing is discriminating. Well, you are, because you're trying to find the best tenant for your property. First line would get rid of that. Whoever meets your qualifying standards gets in, period, end of story. See if that goes through. So you're ready for 2020. So we're in 2020. If I did record this a couple months ago, it was just a normal year. Home prices going up, sales were up, rents were going up. Some of these laws are being passed to protect tenants because of the rents are going up so much. And then the coronavirus hit. And really, let's call, pre-coronavirus March 15th. That was really kind of the D-Day. It actually started coming here in February, but March, we knew this was very, very serious. And it's changed the entire playing field for real estate. And let's go over those ramifications. So the first thing it's done, it's tossed us into a recession. So if you don't know, recessions are always looked in hindsight. So right now we don't know if we're in a recession, but we have a pretty good idea. We always have recessions. So here's the different recessions we've had over the last 40 years. We knew a recession was coming, but a lot of people thought it'd just be a slowdown. We didn't see anything on the horizon. A lot of people thinking maybe 2022, a slowdown, maybe right after the election, if a Democrat was elected and they changed some of the tax laws, maybe that would cause a slight recession, but it'd be really tiny, really minor, no big deal. Maybe if interest rates went up, that might cause a recession. There was all that kind of thing, but nobody saw the coronavirus coming. And we're in the middle of it right now. We're not out of it. So the definition of a recession, if you didn't know, is 2 quarters of negative growth. The Great Recession lasted a long time. It lasted 2 years. It was from 2008 to 2010. Sometimes they're really minor. There's a couple of quarters you even notice it. There was a recession in 2000. Most of us didn't even notice a recession in 2000. Recessions are bad. You might know, why are they bad? Well, recessions involve unemployment. With unemployment, there's no doubt there's suffering. When people don't make money, they are suffering financially, emotionally, physically. It damages the lives of sometimes very innocent people. There are 20 million people out of work now. There are places, a restaurant open around the corner for us, probably has 30 employees. Life was great, opened with a bang, and now they're all out of work. They did nothing wrong, just the coronavirus was introduced to our society. There's a reduction of income. Even if we come back from this one, it's going to be a gradual, we think. But there's always good in a recession. So right now, stocks have come down 35% from the peak. You can renegotiate debt right now. They're doing loans at low interest rates. We have a payment protection program out there. Mortgage interest rates they're at 3%, a little over 3%. They could be below 3%. Great time to refinance. And you can buy assets at a discount. If you're looking at commercial property, probably no better time the next couple of years, because it looks like you can have vacancies of 20, 30% in commercial properties and nobody coming back into those spaces. So there's always somebody who benefits from misery. So let's talk about this one. So we're in the middle of the coronavirus. Federal government jumped in really quick this time. In the last recession, 2008, they kind of dragged their feet. They helped out banks. After a certain time, they started helping out homeowners through banks. But that was about it. I think we had a cash for clunkers program and they spent about $1 trillion. Everybody thought, oh my God, this crazy amount of money, spend $1 trillion. But that was $1 trillion over a 2 or 3 year period. They've already dumped $4 trillion in these stimulus packages between loans and Fed buyouts and handing everybody a couple $1,000. The payment protection program, which is now up to, I think, almost $500 billion for small businesses. We'll update this. Well, the question is, what happens when it comes back, if it comes back again? If this virus comes back again in October or November, is there any money left to do anything? I don't think so. I think we kind of done everything we can at this point. California particularly is in bad shape. We already had a big pension bill due. When the stock market went down 30%, that bill got even higher. And so the Democrats have a supermajority in the Assembly and Senate. Nobody expects them to cut services. We expect them to increase taxes if they can. And already before the coronavirus, Moody's thought we were the least prepared for economic issues. They're already talking about, rather than giving more money to states and cities, let them file bankruptcy. That's the current debate. Maybe they can file bankruptcy and reorganize their pension debt. We'll see what happens. We don't think there are going to be a lot of short of foreclosures and REOs. We think banks will do workouts. We don't see home prices going down 30, 40%. We do see fewer sales. It's really retail this isn't a real estate recession first. This is a retail recession. So it's really the retail and the service sector is getting hit very hard. There will be bankruptcies from retail businesses. We knew Amazon was slowly killing some of these big box retailers while they just pulled the plug on a lot of them. We knew there were too many microbreweries, probably too many restaurants, too many services out there. Well, they're all going to have to come in now and adjust. And as we speak, interest rates are all-time low. Oil prices, a couple days ago, they couldn't give away oil, West Texas oil. They would pay you to take the oil off their hands. Where a barrel of Brent crude used to be $100 a barrel, it's down to $15. So oil's at all-time lows, and borrowing costs all-time lows. So I'll make some predictions. I've been trying to keep an eye on what's going on. So yes, we're in an economic recession. We won't know that for certain for 6 months from now or 9 months from now. There's no doubt the second quarter of 2020 is a recession. Probably, yes, the third quarter in 2020 would be a recession of negative growth. And then I think you see it pull out. But it's just because we bottom out so low, it's going to start creeping out of the very bottom. You can't have record unemployment. We went from 3% unemployment to 20% unemployment in less than a month. And it's not going to go back down to 3% in 2 months. As these restaurants reopen, if I'm a restaurant and I have 50 employees, day one, I'm not going to hire 50 employees. I'm going to hire 20. And I'll kind of, as my cash gets better and as I grow my business, I'll add more employees. Also, at least in California, we're going to have all these distancing rules. So even if a restaurant opens up, they're not going to let them pack them back in again. They're going to say, hey, you can be at 50% occupancy. Almost any business can do that way. So for a lot of reasons, unemployment is going to be a slow slog down. So we'll be at 20%, then a month later we'll be at 19. Every month we'll go down 1%. Well, that means it would take 2 years to get back down to the unemployment lows, assuming nothing else happens, right? So we had record bailouts we talked about. So the big debate is this a V recovery, a U recovery, a checkmark recovery. So a V recovery is super fast. So we opened the doors in July 1st. We're back down to where we were. That's a V recovery. Like it was just a nightmare. It was a bad 3 months and it's over. That's not going to happen. U recovery is bad. U means it goes straight down and you stay at bottom for a couple years and then you start coming back up again. That'd be the Great Recession. That was a U recovery. Most people don't think that's going to happen because fundamentally it's not a housing issue. It's an economic issue, meaning that people out of work and we'll get back there. So I think most people feel like that's not going to happen. And so the winning answer right now is a check mark. So it goes down and just starts slowly coming back up again. And that's seemingly what the economists believe, that barring the unforeseen, that we'll hit bottom in, say, June, July, and we'll start slowly building up the economy again. But we could have a real estate recession. So already the Alt-M mortgage market's gone. That's the alternative. That's when if you just want to give bank statements and putting 20% gone. And that was something like 5% all loans in California, gone. Then they got rid of jumbo mortgages. So mortgages over $700,000. The only way you can get that now if you have a banking relationship with a major bank and you've got like $250,000 in cash with them. Otherwise, gone. So because of that, the high-end market's going to be in decline. Most people believe prices will move 10 to 20% down for homes priced over, say, $1.2 or $1.3 million, which is like, well, how many homes is that? That's a lot of homes. The average sales price in Orange County is $800,000. Average new construction home price is $1 million. So that's a lot of housing. The mid-market, because rates are so low and prices are pretty stable, we see that being more stable. There's some belief they could move 5 or 10% down. Sellers won't want to go down. So you have kind of a standoff between buyers and sellers for 6 months to a year. But I think a lot depends on that market on interest rates. Rates are sitting right now at 3.5%. If rates move to 5%, which historically are super low rates, 5 or 6 or 7%, then you're going to see prices come down in the mid-market tremendously. I would say 10 to 20%, because a buyer's going to say, well, look at my cost of borrowing just went up. Your price has to come down because I want the same cost here. So that's the wild card on that one. And the other wild card is inflation. You just dumped on $5 trillion on new debt onto our debt load. If foreign governments stop buying our debt, we're always starting talking about getting into a trade war with China or making them pay for this. And Saudi Arabia is angry at this person, Iran's shooting at her. Who knows what's going on out there? But if for some reason our debt would not be snapped up, then of course rates would go up. And that could also cause inflation because we put in so much cash. But here's the one thing you can't count on. The others are speculative. There will be more tenant protection laws. You can count on it. Will it be, that rent caps are come down to 2% of CPI? Probably not. But could a 3-day notice to quit become a 10-day notice to quit? Sure. Could a 5-day period of contested eviction become a 30-day period of contested eviction? Absolutely. Could single-family homes be included in rent control? Sure. So I think those things will change, and we have to keep our eye on that. That is definitely going to happen because of this crisis. I said somebody already benefits from difficult times. Well, that's property management. It's really our time to shine. It's easy to self-manage when your tenant is paying as agreed. The laws are really are pro-owner, not tenant. That's a good time to be a manager on property. It's easy. Hard to do in this current economic climate. We love recessions because tenants stumble and they stop paying. So currently on big multi-unit complexes are saying about 20% of tenants aren't paying as agreed. For our portfolio, which is mostly single family homes, condos, and some multi-unit buildings, we're less than that. We're less than 5%. It definitely takes longer to find a suitable tenant right now. Right now, in the coronavirus, tenants are all hunkering down. Nobody wants to go out and find a new property. They want to stay where they are. Plus, if they have rent control, they like that. So it's taking a longer time to find a suitable tenant. Rental prices are softening in certain marketplaces. Good examples, Irvine, where we just put a property on, 2-bedroom. I won't give you the age, but there were 30 other properties on the market. So prices are going to have to soften to attract tenants. A lot of sellers, rather than selling at a discount rent, they say, look, my home was worth $700,000. You're telling me it's only worth $600,000. I'll keep this as a rental and wait till prices go back up again. Real common. A lot of tenants start violating their contract. They add roommates illegally. They don't abide by the terms. And then if the prices really do soften up, already they're talking about a company called Blackstone has $250 billion in investments that they're going to jump in and buy commercial properties at a discount. Well, if residential goes down, particularly multi-unit buildings, they're going to start buying those as well. So once again, what's next? Just cause eviction for all, tighter rent control, relocation assistance, legal assistance when the tenant's represented by an attorney. Do you have to we have to owner registration? We got to register with the state government. Annual inspections we talked about, maybe a certification even. I believe the push in California, there's no doubt the push is for all properties to be under rent control and subject to just cause eviction. That's the push. Will we get there in 2 months or 2 years? I don't know, but that's what you can, I think, expect in the future. And then, of course, cities want to jump in. So they say, well, the state's only doing 5% over CPI. We should do 2% over CPI. Or the state's doing relocation assistance of 1 month's rent. We should do 2 months' rent. So they try to outdo each other on creating more laws. I did want to take a second and talk about why is this happening? So let's talk about the positives for rent control, because there's got to be a reason why everybody wants it. So let's talk about the positives. So when you implement rent control, you now have a sudden increase in the amount of affordable housing stock. meaning that now we talked to a person, take over the management. It was like a 20-unit building. This owner had owned it for like 20 years, never took the rents up. And the day rent control passed, that just created a lot of affordable housing stock, because if she had called me a year ago or a year and a half ago when we took over the property, we could have taken all the rents up for all 20 units immediately. 60-day notice for more than 10%. We could have taken that person renting for $1,100 to $1,600 in 2 months, period. If they didn't like it, they would leave. We got a tenant who would pay the $1,600. That doesn't happen now. Now that's 20 units that are affordable housing that will only be up very slowly over time. Definitely create stable tenancies. Once a tenant's in there and they've locked in the rent, it creates a stable tenancy, and that creates stable neighborhoods, stable schools, stable families. They've done all kinds of studies that people that have rent control stay married longer, kids do better in school, their incomes do better because they become part of the community. For owners, it creates stable income. Once they're in there, they don't leave. So it's almost like a Section 8 effect. They're going to be there, and they like the fact they know exactly where the rent's going to go for the next 20 years sometimes. And arguably, you have better properties. You have state housing authorities involved, so the tenants have the right to call the housing authority and say, hey, this isn't right, and then they force you to do it, or you pay a fine. So there's a claim of better properties. So those are the positives for rent control. Let's look at the negatives. And there are a lot of negatives. So fundamentally, rent control is a violation of your private property rights. You bought the property. You should do whatever you want to with it. Keep it vacant for all you care. But that doesn't happen. There's an interesting statistic that in San Francisco, which is the great example of rent control being around for 30, 40 years, 10% of owners choose to keep the properties vacant rather than rent them out at market. They'd rather not even deal with rent control. Just keep vacant, lose that money. There's zero incentive for you to upgrade or improve. We would turn out a tenant, and then we'd put in a new kitchen. We do this, we do that, and we take our rent from $1,500 to $2,000, and we'd put in $5,000 or $10,000. You can't charge for those improvements, and if there's vacancy decontrol, you can't increase the rent beyond a certain percentage. So, there's no reason to fix and flip. Every economist agrees, and they agree on very little, that over time, rent control creates a shortage of affordable housing, because it's whoever gets in first wins. They don't leave. And then there's no income test. So there's an example in San Francisco, something like 20% of the tenants or 30% of the tenants in San Francisco are considered wealthy. So they're making a couple $100,000, but why go buy a house for $2 or $3 million when I can rent this for $2,500 and put my money in the stock market? And so over time, owners sell, they get out of the market. Nobody builds new in a rent control area because they can't get the return, and your housing stock decreases over time. And lastly, I call it the third wheel. Once you have rent control, you have a housing authority that's looking over it. And we've had a client, his name's Mr. Mitchell, bought a 10-unit or 12-unit building in a Wilmington. And right after he's closed escrow, the tenants used to love the old owner. Old owner would come by and visit, was friends with them all. And we came in as a management company, and they complained to the housing authority that the electrical just wasn't up to snuff. Housing authority went out and said, we agree with you, tenants, and forced our owner to put an all-new electrical in a 1955 building that cost him almost $40,000. Right when he got done with that, they complained to the housing authority that the plumbing wasn't great either. They made him replumb the entire building, another $20,000. So he had a $60,000 bill. He went to the city and said, okay, I did capital improvements. I should be able to increase the rents. And they said, you're right, and we're going to let you do that. I think he could increase the rate $10 per unit per month. So $100 a month. $1,200 a year. It's going to take them 50 years to recoup that investment. So that's the problem with the housing. When you get into rent control, you have to deal with a third party called the housing authority. And it really becomes this class war. It's owner versus renter, rich versus poor, nationalities against each other. It's unhealthy as a society. Long term, you have a lack of, right now we have a lack of properties for sale. They're kind of trapped by low taxes. And we have a lack of affordable housing. That's a real problem. We have a big disparity of property taxes. Somebody bought a home 30 years ago, they're paying $1,000. Somebody paid a year ago, they're paying $10,000. That's true. But we have a quality of rents. The market decides the rents. And we have a quality of prices because the market decides the price. And if you get into this really draconian rent control, you may have boomers getting squeezed out if they unlock Prop 13. And you have more renters. That's definitely true. you have a disparity of rents paid. So somebody, you can have in a building, somebody just moves in, they're paying $3,000 a month, next to somebody paying $1,100 a month because this person got in sooner. You definitely have a disparity of sales prices. So in a rent control building, if that owner didn't increase the rents in the right time, like that person I talked to, now that building's not worth $2 million. That building's only worth $1.2 million because whoever buys it can't increase the rents. And long-term, you have a lack of rentals. Okay, bottom line. So I call those three basic rights. We're seeing more and more of this kind of, as they kind of get empowered, emboldened tenants, and I get it. So one is they want universal housing, that everybody should be able to have a housing at a reasonable cost. I don't know who pays for that, but that's one. Universal healthcare, that was hard to say. We just got through the primaries, and Bernie Sanders said healthcare for all, and that really resonated with the millennials and younger people who don't have it. I get it, I understand it. And the last one's universal basic income. As we see disruption in the marketplace from technology and people, you have 2 million truck drivers out of a job. What do? Well, you might have to hand them $2,000 a month, and that's universal basic income. I'm not saying that's going to happen, but these seem to be the trends. So I believe I built this company, Progressive Property Management, to take advantage of change, and we're definitely in the middle of change. This is my history. I went to Berkeley. I'm not that don't hold that against me. Taking my MBA from Cal State. So I was in banking for a number of years. Got into real estate in the mid '90s. Got into property management in late 2011. And we have Progressive Property Management, which is a property management company for residential real estate. We have Progressive Association Management. That's for HOAs, homeowner associations. We have a full service real estate company and some other companies I do. So, we're here to help you manage better, want to give you the tools to do so. And once you've decided, you know what, I'm not cut out for this anymore, then give us a call. Right now, we're trying to just give you good information so you can be a better owner of your investment property. So what can you do to get ready for all these different trends we talked about? First, if you can, particularly if you have a single family home, you want to get your rents to market, because the day the government says it's rent, when they pass that rent control law, in October, it was retroactive to March. It went backwards 6 months. So bring your rents to market. Second, find the best tenants. Too often we have owners just throw anybody in there. Make sure you have a screening criteria and stick to that screening criteria. Make your contracts airtight. We're happy to give you our contract and get rid of our logo, but you need really good rental contracts. So if you have to go to eviction, it's going to hold up in a court of law. Should be one page. I can guarantee that. Should be many more pages than that. Maybe you don't do a 12-month lease. So if your property is more than 2 units or more, if it's the contract's not a year, let's say it's 11 months, you can remove that tenant and then you're good. But if your contract's 12 months, they get the benefits of that rent protection law. So maybe shorten the terms of contract, particularly for those types of property. Make sure your property's to code, because they will complain on you and you'll be forced to fix it. We strongly recommend you get 2 months secure deposit. There are companies out there, insurance companies will insure the balance of it. We do that as part of our company, and we'll talk about that in a little bit. But there's no reason why the tenant doesn't come up with 1 month and pay you the other month over a 12-month period. Do a payment plan if you have to, but you really want those 2 months security deposit. We'll talk about that in a little bit. We have a lot of owners just don't want to deal with this. It's tough. It's not easy self-manage. So if you want to self-manage, and you're not getting the return you want, maybe it's time to do a 1031 and sell your property, pay no capital gains, and buy another property in a non-rent control area or non-rent control state even. But it's going to get harder, not easier, to self-manage. It's going to be harder, not easier, to get the same return out of your investment property in California. And lastly, you wouldn't respect me if I didn't say that you should consider professional property management. People think the cost for property management is high. It's just not high. Let's say our average property management fee for a $2,500 rental is $125. You get to write that off. So that's a cost to you of maybe $80. Call that $3 a day even. I think it's worth your time and your money to hire somebody like us, but we'll talk about that. So this is our company. We're a little unique where we have centralized operations and local property managers. So we're able to achieve a really low cost to you because my main office is located in Placentia, which is right next to Anaheim at the 57th and 91. But we now have 30 branch managers throughout Southern California, and they are my boots on the ground. So I might have a property manager in Chino who manages 100 properties, but I have somebody in Orange who manages 50, and I have somebody in San Fernando Valley managing 60. So they can provide a higher level of service, because a typical property management company, a property manager manages 100 to 200 properties. We don't do it that way. So that's a little different. And we do cover all of Southern California, most of Riverside, San Bernardino, most of LA, and we just hired somebody for Coachella as well. And we do have the resources here to help you. If you want us to continue to manage by owner, we'll help you do that and give you the tools. And we'll talk about our pillars in a little bit, which we try to do it a little bit better than other management companies. I believe our job here is to solve your pain points. And if you're self-managing, you've got pain points. So we have programs specifically designed to, I'd like to say that to make the rental experience better for your tenant and to better protect your asset. So eviction protection. So we will charge your tenant $15 a month, and they pay it. And if we have to evict that tenant or a future tenant, we pay for the cost of that eviction. That's going to save you about $1,000. We believe in damages of your property. We have a preferred tenant program. We talked about the 2 months. I think it's critical. So we say to the tenant, our owner wants 2 months security deposit. And if you can't or unwilling to pay the second month, they can always put up the first month. Then we charge them a small fee. It's between 1% of the rent to 2%, depending on the credit score. So let's call it on a $2,500 rental, $25. And then when they move out, if there's any damage beyond the first month's rent, the $2,500 we already have a security deposit, we pay for that up to $5,000. And then the other thing we're going to do is if they behave as agreed and they move out, then we'll give them 25% of everything we collected up to that point. You have to have tenant liability insurance. You should get a policy. So you can't require renter's insurance. You can, but it's not enforceable. But you can require liability insurance. We have a policy. It costs a tenant $10, $15 for a $100,000 policy where you're the beneficiary and there's no deductible. You must require tenant liability insurance. So if they have a grease fire and it causes $50,000 damage to your kitchen, they don't have $50,000. They couldn't cover the second month's security deposit, but you have insurance in place. And lastly, we offer tenant guarantees. So if they don't perform the first 12 months, we find you another tenant automatically. I think our ultimate job isn't just to collect rents and make disbursements. That's the easy part of our job. We're here to be the wall between you and the tenant. And what I mean by that, the more that you decide which tenant should be in your property, the more you decide which vendor should work on your property, and the more that you decide how much the security deposit tenant get back, the more liable you are, the more you're going to get sued by the tenant because you didn't make the right decision. The more we do that for you, we pick the tenant, we use our vendors, we decide on the security deposit, and if they don't like our decision, they're going to sue us. And that's okay. I'm prepared for that. But you shouldn't be. So we like to think we're the wall between you and the owner. We want you to treat this as a passive asset. And every month you're collecting rental income. If there's an issue, we take care of it. But you don't have to think about it on a Thursday. You don't have to worry about a water leak on a Sunday. We take care of that stuff. Our 4 pillars is really important to me. When I built this company, I went out to self-managing investment property owners and I said, what is it you don't like about property management companies, and what would it take for you to like them, to hire one? And owners are pretty clear what they wanted. They wanted value, transparency, great customer service, and a fair price. And let's go over those. So I know you have to trust us. We offer value propositions so you can do that. And those are compelling. And we have the owner programs. We have our 8 guarantees we'll touch upon briefly. So we want you to trust us and we want you to believe us. So on our website and all our marketing, we're completely transparent. We have our contract online. You're going to see we have a map of all the properties, all our branch managers, totally transparent. We're hiding nothing. Our pricing is right there on our website. You want to like us, because if other owners don't like us, you're probably going to feel like, well, you're not going to like us as well. So we provide stellar customer service to our owners. And you'll see that through our Google reviews and our Yelp reviews, which are hard to do in this business because tenants sometimes don't like us because we enforce the rules. But nevertheless, we provide great customer service, and you want a fair price. And we're going to talk about our pricing here in a little bit. Because if you don't have value, it all comes down to price. And we have value. First, we offer 8 performance guarantees for free. So if we don't perform as promised, we pay a real financial price. And you can see what these different guarantees are: payment, service fee. A big one is response. If we don't return a call, email, or text within 24 hours, not including the weekends, we waive that month's management fee. So we pay a price. And if you're not happy with us, cancel your contract. Just give us notice, 60-day notice, or you're out of the contract. Even if you sign a 1-year contract, you can cancel it. We talked about being transparent. This is a map of all the properties we manage. So currently, Progressive Property Management manages about 1,000 residential doors throughout all of Southern California, from Apple Valley down to Temecula. Progressive Association Management manages about 400 owners, and that's a part of our business we're growing. We do have a comparison chart on our website, so you can compare us against other companies. I don't pick bad companies, try to pick the best ones in our market area, so you can quickly compare us to others. These are our Google reviews and our Yelp reviews. Once again, not easy to do, but we feel like our reputation matters. It matters to you and it matters to us. And we're very keen on that. And if somebody's not happy, I want to hear about it so I can talk to them about it. So you're typically aware of pricing in our business is usually a percent, right? A fixed percent, 5, 6, 7, 8%. Fixed fee, so $95, $125, $150 a month. But I bet you never heard of hybrid. So we're going to look at the 3 ways. We are hybrid pricing. And what I mean by hybrid pricing, we charge a flat fee plus a percent. And the reason we did this, because we manage properties as little as $1,000 as much as $10,000 a month, that I want to be able to offer the same pricing to everybody, be totally equal with all. And so by doing it this way, no matter where your property is located, no matter how much you rent, you have the same pricing as somebody else. Simple as that. So we have a hybrid pricing model. I'll kind of go over it quickly. So this would be 6% versus 125 versus our hybrid at $75 plus 2%. So if you had a $2,500 rental, we're the same as the fixed fee, but we're lower than the 6%. And so you can see we get, the higher you go, the better we are against a percent. And then of course, if your rental is only $2,000, we're lower than the fixed fee. So as a way for us to, as prices go up, we're compensated, but as they stay down, it's still a low fee. Because if I'm charging 6% and it's a $4,000 rental, you're going to pay $240. But if the property is only $1,000, I can't live on $60. We can't make a profit. So this is why we came up with the hybrid pricing. We're implementing this pretty soon on our website, if not already, if you haven't been there. So we offer 3 pricing plans. This is for single-family homes and condos. So basic, complete, or premium. Basic, you just pay a few more fees, the lease renewal, annual inspection. And then we do have a tenant acquisition fee. So we charge 30% for our services of the first month's rent. And we offer 10% as a commission to another party. If we represent both parties, we retain that. If there's a realtor involved, we pay them. The premium, the basic difference in premium is we've come up with a rental warranty program with American Home Shield. And it's just like kind of a home warranty that you're used to. So we cover anything breaks, it's covered. Dishwasher dies, we replace it. AC breaks, we fix it. And so it's a way for you to know you've limited your exposure to costs. And then additionally, what we do is we also give you 4 hours of free annual maintenance. So we have a handyman, and he'll go to your property and do a carpet cleaning, do a fix-up, do a turn. If the ceiling fan, needs to be replaced, do that as well. So that way you're completely covered between the rental warranty program and our handyman. But our most popular is $75 plus 2%. A lot of things are included, so you kind of know what you're getting into. We have different companies. If you want us to do an inspection of your property, we'll do that for a fee. We have insurance services. We have renters insurance. We have a maintenance company. Of course, you're here at the Renter State. We also do local landlord seminars. We haven't done one in a while because of the coronavirus, but we try to do one every 3 months throughout Southern California, but particularly in the Anaheim area. And we'll bring in 50, 60 owners, and we'll kind of go through this with them, what I went through with you, but more detail, take questions, go through the legal stuff as well, and insurance products, all that kind of stuff. So sometimes it's free. Sometimes we charge $19, depending on the program and the seminar, but you're welcome to be there. I hopefully do one. We can't have more than 10 people in a room right now. I don't know when that's going to end, but I'm hoping, September we can do the next local landlord seminar, but we'll do it when we can. The 3 themes the themes we go through in that seminar is if you're self-managing, you're a property manager, you're subject to the same laws we are, same risks, same insurance. We like to think we can do it better. We give you some horror stories, and we talk about a little bit of how to get richer in real estate, how to do improve your return on equity, how to do a 1031 tax exchange. We touch upon that as well. and we take a lot of questions because you guys have a lot of questions. That's what it looks like. That's my office. So you can see we have about 30, 40 people there. Said 45, that sounds right. And we help them become better property managers. That's our slogan. We really do want to make happier owners and tenants. We like to say we manage happiness, not just properties. And we'd love to help you if you get to that stage. Here's some contact information for you. That's my personal email. That's our new website, progressive-PM. There's our old website, propropinc.com. Happy to give you how to hire a property manager. We have an owner's manual. I can give you a contract, a lease agreement. And then, of course, we talked about the local landlord seminar. So thank you for your time. And we look forward to assisting you. And stay healthy out there during this coronavirus.